Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Swan, and in each episode I share my thoughts with you on a topic or a recent development in the field of South African tax. And I try to keep each episode to around 10 minutes or so, that you can listen to it while you are enjoying a quick cup of coffee if you take a break from work. Our question for today is, what are some of the tax considerations that you need to consider when waiving a loan? Now, if we talk about a loan, we're looking at an arrangement or a transaction where there's two parties involved. We've got the lender, the party who advanced the funds, and the borrower, the party who obtained the funds. And the borrower would have an obligation to repay this amount, possibly with some interest on it, to the lender at some point in time. When we're then talking about a waiver or a write-off, it simply just means that the borrower is no longer required to repay the amount to the lender. And we've got many variations on this. You find that these transactions can be called waivers, they can be called cancellations. You find variations where the borrower acquires the claim against itself from the lender, and in that process the obligation to repay the lender is extinguished. And as you can imagine, some of these variations are quite complex and you really require detailed tax advice on that. So the variation I'm going to talk about today is the most basic waiver or write-off of a loan. And I think, as you'll hopefully see, even that variation has got a bit of complexity to it. Right, so let's start with the borrower. When a loan owing by the borrower is written off, this triggers a debt concession or a compromise for the borrower. And we look at Section 19 of the Income Tax Act, and then also paragraph 12A of the 8th schedule of the Income Tax Act that would apply to such a debt concession or compromise. Now, what these debt concession or compromise rules in concept do, they basically just reverse the effect of the expense, the tax effect of the expense that was funded with the loan that is now being written off or cancelled. So let me give you two examples. If the loan funded, so let's say the company took a loan, it used the loan to pay salaries and it claimed a deduction under Section 11A for those salaries. Now, at a later stage, the loan is being written off. Economically, if you think about it, how much of the company's own funds did it really, well, what was the outflow in the greater scheme of things? And the reality is that if you've paid money for the expense, but on the other side, you are no longer required to repay that amount or to pay that amount to someone else, for this specific taxpayer, there's been no outflow. So what these debt concession or compromise rules do, if the loan was, or the loan funded a deductible expense, the compromise and concession rules would require that there's a recoupment of the expenditure that was funded. So basically to put you back in the same position that you would be, to reflect the fact that there was no real outflow for the taxpayer. If on the other side the loan funded a capital asset, you would find that the expenditure incurred by the taxpayer for that capital asset sits in the base cost of the asset. So in that case, if the debt is waived, the base cost of the asset must be reduced to reflect what the real cost for the taxpayer would be. If the asset was disposed of before the waiver happened, then the capital gain or loss arising on that disposal must be adjusted for the effect of what the reduced base cost would have been. So many people, when we talk about waivers or cancellations, go to these debt concession or compromise rules first, as I also did in this case. And that's not necessarily the right approach. So the first question to really ask yourself is this loan recoverable? And with a lot of these waivers and cancellations, you find that the waiver and cancellation happens between connected persons. So it may be that the waiver or the write-off is is motivated by something other than the fact that the loan is not recoverable. So if the loan is recoverable and the lender gives up the right to repayment, that's a donation by the lender, and that donation could be subject to donations tax. The link between donations tax and the debt concession or compromise rules then, if the concession or compromise was subject to donations tax, then the debt concession and compromise rules that I spoke about a bit earlier do not apply. Of course, I think it is important to just mention that the donations tax effect isn't an effect for the borrower. It's an effect for the lender, or it's a tax that's levied on the lender who waives the right to repayment if that right has got value. So in other words, if the right is recoverable or the loan is recoverable. If we look at the lender side of it, the lender disposes of this right that I just explained. So that disposal of the right would be a disposal of an asset. So in other words, a trigger event for capital gains tax. The lender would, if the loan is written off, dispose of the right for no consideration. And it's very likely that the lender would then have a capital loss that you need to look at. Now, when it comes to these capital losses that arise in respect of connected person debts, then as a general rule, the lender must disregard the loss. So that's under paragraph 56(1) of the 8th schedule of the Income Tax Act. And then we find in paragraph 56(2) that there's and I'm just going to paraphrase it very broadly, that the lender can take the loss into account if another person took the benefit into account in their taxable income. So to look at how that other person should have taken the benefit into account, I would refer you to paragraph 56(2) of the 8th schedule. There's a detailed, a few items there that detail how the amount should have been taken into account before the lender can then take the loss into account in its taxable income. And this loss would then not be ring-fenced despite being from a transaction with connected persons. Also interesting here, in the SARS Capital Gains Tax Guide, SARS indicates that paragraph 38 of the 8th schedule, so now that's the paragraph that deals with disposals, amongst others, between connected persons not at arm's length. And that paragraph would, as a rule, deem that disposal to then have occurred at the market value of the asset. So SARS's view is that in the case of a waiver or a write-off of a loan, that loan is not disposed of to another person. And for that reason, paragraph 38 does not apply. Otherwise, you could have possibly had a scenario where the loss may not arise in all circumstances. So as I've mentioned, and in closing, there are many variations and exceptions to consider that I didn't touch on. Some of them are, for example, if the loan is capitalized by a company through issuing shares rather than written off, there's a specific regime that applies to those kind of transactions. And then these debt concession and compromise rules are also subject to many group exemption or a few group exemption rules. So in closing, we've spoken about some of the tax considerations to include concessions, these debt concession rules, donations, but many loan restructurings and rationalizations are not simple waivers, and you do need specific tax advice on that. Thank you for listening. If you enjoyed, please subscribe on your podcast platform and tell all your friends and colleagues about this podcast. If you've got any questions that you would like me to discuss in a future episode, you're welcome to send me an email. My email address is in the show notes, and I'll have a look at it, and maybe I'll build a future episode on your idea. As always, this podcast is not intended to be tax advice or even a replacement for fact-specific tax advice. Until next time, goodbye.